In October of 2022, Nvidia's market value stood at around $300 to $350 billion. 8 months later, on May 30th, 2023, it crossed $1 trillion for the first time. Nvidia became the first semiconductor company in history to reach that threshold. And it did so in under a year from the $300 billion mark, a pace of growth that outstripped the trajectories of Apple and Microsoft when they reached the same milestone. And Nvidia wasn't alone. Estimates suggest hundreds of billions of dollars, including individual alliances, valued at over $600 billion, have been committed to AI infrastructure, data centers, cloud services, and chips in just the past few years. Investment in technology and AI, in which data centers play a major role, contributed roughly 1 to 1.5 percentage points to US GDP growth in 2024, according to Bank of America. 75% of the S&P 500's gains since late 2022 have been driven by AI-related stocks, according to JP Morgan Asset Management. It's a gold rush of unprecedented scale. But here's the thing. When Sam Altman, the CEO of OpenAI, and arguably the person most responsible for igniting this frenzy, was asked whether we're in an AI bubble, his answer was surprisingly candid. "Are we in a phase where investors as a whole are overexcited about AI?" he said. Yes, Jeff Bezos called it kind of an industrial bubble. The CEO of Goldman Sachs warned that much of the capital being deployed won't deliver returns. These aren't skeptics on the sidelines. These are people with billions on the line. So the question we're examining today is simple, but its implications are enormous. Is the AI hardware boom the foundation of a new technological era? Or are we watching the inflation of the biggest bubble in tech history? This is that story. To understand what's happening, you need to understand the people making it happen. At the center of it all is Jensen Huang, the CEO of Nvidia. In March of 2023, wearing his signature leather jacket, Huang stood on stage at Nvidia's annual conference and declared that the iPhone moment of AI has started. It wasn't just marketing speak. Nvidia currently controls roughly 80% of the market for AI accelerators in major data centers like AWS, Azure, and Google Cloud. In practice, that means the vast majority of large-scale AI model training runs on Nvidia's GPUs. Under Huang's leadership, the company has become not just a chip supplier, but the infrastructure provider for an entire industry. Then there's Sam Altman, the 38-year-old CEO of OpenAI. Altman is the person most directly responsible for igniting this frenzy. ChatGPT's explosive debut demonstrated what generative AI could do, and suddenly, everyone needed compute power. But Altman's ambitions go further. In 2024, reports surfaced that he was seeking up to $7 trillion in capital to build a global network of AI data centers. To put that in perspective, that's roughly comparable to, or slightly larger than, the inflation-adjusted cost of World War II for the United States. When asked about the figure, Altman acknowledged the scale, but stood by the vision. The demand for chips, he argued, was only going to grow. Mark Zuckerberg represents a different kind of player. For years, Meta bet heavily on the metaverse. That bet didn't pan out. In early 2023, facing pressure from investors and his own board, Zuckerberg pivoted hard. Advancing AI, he told his team, is our single largest investment. Meta projected spending roughly $38 to $40 billion on capital expenditures in 2024, primarily for AI infrastructure, and $60 to $65 billion in 2025. The company aims to have approximately 1.3 million GPUs deployed by the end of 2025. It was a remarkable turnaround, and a signal that even the biggest tech companies felt they couldn't afford to be left behind. But here's what almost no one talks about. This entire trillion-dollar frenzy depends on two companies you've probably never heard of. And if either one goes down, the whole thing collapses. Let me show you. The first is TSMC, Taiwan Semiconductor Manufacturing Company, run by CEO CC Wei. TSMC currently manufactures virtually all of the world's most advanced AI chips, including Nvidia's H100 and Blackwell GPUs. Every cutting-edge Nvidia chip is made in TSMC's fabs. Wei has been bullish on AI, stating that AI demand is real and just the beginning. But TSMC's central role also makes it a single point of failure. If anything were to disrupt production in Taiwan, the entire AI hardware supply chain would grind to a halt. And then there's ASML, a Dutch company led by Peter Wennink. ASML makes the extreme ultraviolet lithography machines required to produce the most advanced chips. These machines are priced at roughly $170 to over $200 million each, and ASML is the only company on Earth that makes them. Without ASML's technology, neither TSMC nor anyone else can make cutting-edge chips. Wennink has been vocal about the risks of politicizing technology, warning that export restrictions and trade wars could backfire by pushing countries to develop their own alternatives. So you have three types of players here. The evangelists, like Huang and Altman, who are driving demand. The late movers, like Zuckerberg, scrambling to catch up. And the gatekeepers, Wei and Wennink, who control the choke points of the entire supply chain. It's a high-stakes game, and the decisions these five individuals make will shape not just the tech industry, but the global economy. This didn't happen overnight. The seeds of today's AI hardware boom were planted more than a decade ago. Now, to understand how we got here, I need to take you back. Because this didn't start with ChatGPT. It started with a nerdy image recognition contest in 2012 that almost nobody noticed. But what happened next set off a chain reaction that no one saw coming. AlexNet ran on Nvidia GPUs, graphics processors originally designed for gaming. The results were so much better than traditional methods that it became clear GPUs weren't just for rendering video games anymore. They were the future of AI research. Nvidia, which had been primarily a gaming hardware company, suddenly saw a new wave coming. 3 years later, in 2015, Google quietly deployed something called a Tensor Processing Unit, or TPU. These were custom-designed chips built specifically for AI workloads, used internally to accelerate AI systems, including components of Google Search, like ranking and query understanding. It was the first signal that big tech companies were starting to design their own silicon, reducing their dependence on traditional chip manufacturers. Then came AlphaGo. In 2016, Google DeepMind's AI defeated Lee Sedol, one of the world's best Go players, in a match that captivated millions. The version that played Sedol ran on a cluster of 1,920 CPUs and 280 GPUs. Later versions of AlphaGo and AlphaZero would transition to using TPUs. For the first time, the general public saw what AI was truly capable of. And behind the scenes, demand for AI accelerators began to climb. By May of 2017, Nvidia had fully committed to the AI market. Jensen Huang unveiled the Volta 5 100 GPU and made a bold claim. Moore's Law, the principle that chip performance doubles every 2 years, was slowing down, he said. But there was a new dynamic, later dubbed Huang's Law by the press. GPU performance for AI workloads, he argued, was accelerating even faster, roughly 1,000-fold improvement over a decade, and it would be the driving force behind AI's growth. Nvidia positioned itself not just as a chip supplier, but as the backbone of the entire AI industry. Then came 2020, and COVID-19. The pandemic triggered a global chip shortage. Suddenly, semiconductors weren't just important. They were strategic assets. The world realized how dependent it had become on a handful of companies like TSMC and ASML. Governments began pouring money into domestic chip production. The geopolitical importance of semiconductors had never been higher. But the real turning point came on November 30th, 2022. That's when OpenAI released ChatGPT to the public. Within 2 months, ChatGPT reached 100 million users, according to analysis by UBS. It was the fastest growing application in history. More importantly, it demonstrated to the world, in a way that was impossible to ignore, what generative AI could do. As Sam Altman would later put it, ChatGPT woke up every boardroom. Suddenly, every major tech company felt they had no choice but to go all in on AI. And that meant one thing: they needed compute power, lots of it. Demand for Nvidia's GPUs became, in Altman's words, insatiable. So when you look at where we are now, with hundreds of billions being poured into AI infrastructure, it's not a sudden mania. It's the result of more than a decade of steady progress, each breakthrough building on the last, each one raising expectations a little higher. AlexNet showed that GPUs could power AI. AlphaGo showed what AI could achieve. And ChatGPT showed that AI could be accessible to everyone. But here's the question. When expectations rise that quickly, when every breakthrough is seen as proof that the next one will be even bigger, when do ambitions cross the line from visionary into irrational? That's what we're about to find out. After ChatGPT, the floodgates opened. In March of 2023, Jensen Huang took the stage at Nvidia's annual developer conference and delivered what would become one of the most consequential keynotes in the company's history. The iPhone moment of AI, he declared, has started. He unveiled DGX Cloud, a service that would let companies rent supercomputer-scale AI infrastructure for $36,999 per month per 8 GPU instance. By the end of the first quarter, Nvidia's stock had risen 77%. But that was just the beginning. On May 25, 2023, Nvidia shocked Wall Street. The company projected quarterly revenue of around $11 billion, roughly 50% above analyst estimates. One analyst called the forecast unfathomable. Another described it as cosmological. The next day, Nvidia's stock surged 24% in a single session, adding approximately $184 billion to its market value. It was the largest one-day gain in history for a semiconductor company. 5 days later, on May 30th, Nvidia's market capitalization crossed $1 trillion. It became the first chipmaker ever to reach that threshold. Jensen Huang's personal fortune increased by more than $20 billion in a matter of months, and the demand kept building. By mid-2023, Nvidia's H100 GPUs were extraordinarily scarce. Rental prices on some cloud platforms reached levels far above normal rates during the shortage. Startups that couldn't secure GPUs through traditional channels turned to unconventional methods. Crusoe Energy, an infrastructure provider, borrowed $200 million from banks to buy GPUs. Meanwhile, CoreWeave secured roughly $2.3 billion in credit facilities backed by Nvidia H100 GPUs. Venture capital firms poured money into anything related to AI. By mid-year, 58% of all VC funding was going to AI companies, a concentration not seen since the height of the dot-com boom. The big tech companies were spending even more aggressively. In 2023 alone, Meta spent $30 billion on AI infrastructure. To put that in perspective, that's more than the GDP of some countries, and they weren't even close to being done. One Meta engineer described the scale this way: "We're basically building a nuclear power plant worth of capacity every quarter." Microsoft committed $80 billion to AI data centers in 2025. Amazon, Google, and others followed with similarly massive investments. In total, according to JP Morgan, AI-related companies accounted for 75% of the S&P 500's gains since late 2022. Roughly 90% of capital expenditure growth within the S&P 500 was driven by AI-related firms. By 2024, technology and AI investment, including infrastructure, was contributing more than 1 percentage point to US GDP growth, according to Bank of America, rivaling or exceeding traditional sectors like residential construction in some quarters. It was, by any measure, a frenzy. But here's where things get interesting. In the middle of all this euphoria, cracks were starting to show. Nvidia's valuation had climbed so high that its price-to-earnings ratio hit 110, roughly 6 times the semiconductor industry median. Investors were pricing in not just continued growth, but sustained dominance across an entire generation of technology. And yet, a 2025 study from MIT found that roughly 95% of enterprise generative AI projects showed no measurable impact on profitability. The technology was everywhere, but the financial returns were elusive. Meta had spent tens of billions on AI, but by the end of 2023, the company still hadn't launched a single consumer-facing AI product that gained significant traction. Microsoft's AI tools were being used, but it wasn't clear whether they would generate enough revenue to justify the infrastructure costs. Public estimates suggest OpenAI was spending at least $700,000 per day on compute in 2023, with total inference and training costs potentially reaching billions annually, yet its revenue didn't come close to justifying its valuation. In other words, the money was flowing, but the value it was supposed to create, that was still theoretical. And if history has taught us anything, it's that when investment vastly outpaces returns, someone eventually pays the price. By the end of 2023, the cracks started to show. And when I say cracks, I don't mean small ones. I mean the kind that make billion-dollar investors nervous. Here's what they saw. Reports began emerging that GPU rental prices, which had been extremely high during the shortage, were declining significantly as supply improved. Some cloud providers reduced prices by 40 to 50% as capacity caught up with demand. Many startups and smaller providers that had hoarded GPUs, often reserving capacity from multiple vendors out of fear they wouldn't be able to get enough, began offloading their excess. Suddenly, there were more GPUs available than there were immediate workloads to run on them. It was the first tangible sign that demand, while still high, might not be infinite. Then there was the insider selling. In late 2023, Nvidia executives and early investors sold shares at volumes not seen in years. Technically, this is normal. People cash out. But the timing raised questions. If the company's prospects were as limitless as the public narrative suggested, why were those closest to it locking in gains? And it wasn't just market signals. The people driving the boom were starting to say the quiet part out loud. In August of that year, Sam Altman was asked directly whether we were in an AI bubble. His answer was striking. Are we in a phase where investors as a whole are overexcited about AI? He said, yes. He went on to compare it to the dot-com era. People will overinvest and lose money. This from the CEO of OpenAI, the company that had arguably done more than any other to ignite the frenzy. David Solomon, the CEO of Goldman Sachs, was even more blunt. I expect there to be a lot of capital that was deployed. He said, that doesn't deliver returns. Then there were the numbers on the ground. The MIT study found that 95% of companies that had adopted generative AI saw no measurable increase in profitability. The technology was being implemented, but the financial benefits were either negligible or hadn't materialized yet. Meta was a case in point. The company had spent roughly $10 billion on AI infrastructure and research in 2023. And yet, by the end of the year, it still hadn't launched a single consumer-facing AI product that gained significant traction. AI personas, chatbots integrated into its platforms. These were met with lukewarm reception at best. There was a stark contrast between the scale of investment and the visibility of results. Even within Nvidia, there were signs of caution. A leaked comment from Ian Buck, a vice president at the company, reportedly summed it up this way. It's not demand that's unlimited. It's our customers' imagination that's running wild. In other words, Some of the orders Nvidia was receiving weren't driven by immediate need. They were driven by fear of being left behind. Now, none of this means the AI boom is over. Demand for compute is still growing. The technology is still advancing. But what these signals suggest is that the rate of investment has outpaced the rate at which value is being created. And when that gap gets too wide, markets tend to correct. The question is whether that correction will be gradual or sudden. While the financial frenzy was building in boardrooms across Silicon Valley, another shift was taking place, one that had less to do with profits and more to do with power. On October 7, 2022, the U.S. Commerce Department issued sweeping export controls on advanced semiconductors. The rules were straightforward. Nvidia and AMD were prohibited from selling their most powerful AI chips, the A100, H100, and MI250, to Chinese customers without special licenses. The stated reason was national security. AI, the logic went, could be used for military applications, surveillance systems, and other capabilities the US didn't want China to develop. Nvidia responded quickly. Within weeks, the company had created modified versions of its chips, the A800 and H800, with artificially limited performance to comply with the new regulations. But the message was clear. Semiconductors were no longer just products. They were instruments of geopolitical strategy. And the restrictions didn't stop there. The Netherlands, under pressure from the United States, barred ASML from selling its extreme ultraviolet lithography machines to China, and later restricted some advanced deep ultraviolet tools as well. These are the systems required to manufacture the most advanced chips in the world. Without them, China's ability to produce cutting-edge semiconductors would be severely constrained. Peter Wennink, ASML's CEO at the time, was openly critical of the move. These discussions, he said, are not being conducted on the basis of facts, but on the basis of ideology. If ideology cuts straight through, I have a problem with that. His concern wasn't just about lost revenue. It was that restricting access would force China to invest heavily in developing its own lithography technology, potentially creating a competitor to ASML in the long run. And in some ways, that's exactly what happened. In January of 2024, teardown analysts examining Huawei's Mate 60 Pro smartphone discovered something unexpected. Inside was a Kirin 9000 seconds chip, estimated to be manufactured on a 7nm class process by SMIC, China's leading foundry. This shouldn't have been possible according to conventional understanding. SMIC didn't have access to ASML's EUV machines. But analysts concluded the company had apparently found a workaround, using older, deep ultraviolet technology with advanced multi-patterning techniques to approximate the results. It was a signal that sanctions, while effective in the short term, were accelerating China's push for self-sufficiency. China also ramped up development of its own AI chips. Huawei's Ascend line, launched in 2019, was positioned as a domestic alternative to Nvidia's offerings. Progress has been uneven, with industry analysts suggesting that yield rates and cost-effectiveness for some advanced Chinese-made AI chips remain challenges compared to TSMC's production. Still, the intent was clear. China was not going to accept technological dependence. Meanwhile, governments around the world began pouring money into semiconductor manufacturing. The U.S. CHIPS and Science Act committed $52.7 billion in subsidies and incentives for domestic chip production, with TSMC committing $40 billion to a new facility in Arizona. China countered with a support package of over 1 trillion yuan, approximately $143 billion, in the form of subsidies and tax incentives for semiconductor companies. Japan, the European Union with its €43 billion CHIPS Act, and India all announced similar initiatives. In total, more than $300 billion in government funding across the US, China, the EU, Japan, South Korea, and other nations has been committed to chip production this decade. These aren't market-driven investments, they're strategic hedges. Every major economy now views semiconductor production as a matter of national security. And that brings us to the uncomfortable reality. TSMC, based in Taiwan, manufactures virtually all of the world's most advanced AI chips. If anything were to disrupt operations there, whether from natural disaster, political instability, or conflict, the global tech industry would face a crisis far worse than any supply chain disruption we've seen. In other words, the AI hardware boom isn't just an economic story, it's a geopolitical one, and the stakes are higher than most people realize. Behind the public narrative of visionary CEOs and trillion-dollar investments, the reality was often more chaotic. Take Meta. For years, Mark Zuckerberg had bet the company's future on the metaverse. By early 2022, Meta's Reality Labs division was losing billions every quarter, and the stock had collapsed. Internally, frustration was mounting. A leaked memo from September of that year, written by Meta's infrastructure head, warned bluntly, "We have a significant gap in developing for AI. We need to invest heavily here." Then came a board meeting where Peter Thiel, one of Meta's longest-serving directors, reportedly confronted Zuckerberg directly. He criticized the CEO for focusing too much on the metaverse while being complacent about the core business and AI. It was a rare public rebuke. What followed was a dramatic reversal. Meta cancelled its custom AI chip project, which had been years in development, and instead placed orders for more than $1 billion worth of Nvidia GPUs. The company was literally air freighting hardware to its data centers to catch up. After years of insisting it would build everything in-house, Meta had effectively admitted it didn't have time. It needed to buy its way back into the race. Google faced a similar dilemma, but for different reasons. The company had pioneered custom AI chips with its Tensor processing units, which by 2019 were reportedly saving the company more than $1 billion a year in compute costs. But when ChatGPT launched, Google realized that TPUs alone weren't enough. The company needed more flexibility, more raw power to compete at the speed the market was moving. So Google began ordering tens of thousands of Nvidia H100s for its Gemini project. A leaked internal document from April 2023 captured the concern. Titled, "We have no moat and neither does OpenAI." It argued that open-source AI models were iterating faster than Google's closed efforts, and that the company's technological advantage was eroding. It was a sobering admission from engineers inside one of the world's most advanced AI labs. Then there's Nvidia itself. In mid-2022, the company was actually in trouble. The cryptocurrency market had crashed, and demand for GPUs from miners evaporated overnight. Nvidia was forced to write down $1.22 billion in excess inventory, primarily related to gaming and crypto. Jensen Huang made a risky call. He redirected nearly all of the company's advanced manufacturing capacity toward AI chips, specifically the H100. It was a gamble. If AI demand didn't materialize, Nvidia would be stuck with another glut. But when ChatGPT launched 5 months later, that bet paid off in spectacular fashion. There was drama at OpenAI too. In November of 2023, the company's board abruptly fired Sam Altman, citing vague concerns about communication and governance. The move shocked the industry. Within days, after a public outcry and pressure from Microsoft, which had invested an estimated $13 billion, including cash and Azure infrastructure credits in the company, Altman was reinstated. The episode revealed just how fragile the leadership dynamics were, even at the epicenter of the AI boom. It also prompted Microsoft to accelerate development of its own AI chip, codenamed Athena, to reduce dependence on external suppliers. Industry observers have noted rumors of complex cross-shareholding arrangements and partnerships among Nvidia, OpenAI, AMD, and others. Those specific details of such deals have not been publicly confirmed. But perhaps the most unexpected twist came from an unlikely source: open source AI. In early 2023, Meta released LLM-A, a large language model intended for researchers. The model was leaked almost immediately, and within weeks, the open source community had fine-tuned and improved it in ways Meta hadn't anticipated. What this demonstrated was that you didn't need hundreds of billions of dollars and massive GPU clusters to build competitive AI. You could take an existing model, fine-tune it for specific tasks, and achieve impressive results with a fraction of the resources. This was a problem for the narrative driving the hardware boom. If smaller, more efficient models could deliver most of the value, then the demand for ever larger training runs and the GPUs required to power them might not grow as fast as everyone assumed. In other words, the industry's biggest players were scrambling, pivoting, and hedging, often in real time. And the technological landscape was shifting faster than anyone could control. It turns out, even at the highest levels, no one really knew what was going to happen next. Every boom creates winners and losers. This one is no different. The winners are obvious. Nvidia's revenue and profit roughly doubled in 2023. In 2025, TSMC reported year-over-year revenue growth approaching 40% for some quarters, with high-performance computing and AI accounting for the majority of wafer revenue, though smartphones, automotive, and other sectors also contributed. Machine learning engineers saw their salaries surge, often commanding offers well into six figures straight out of university. The big tech platforms, Meta, Google, Microsoft, had the resources to buy their way into the race. They could afford to make mistakes and still keep going, but the losers are less visible, and their stories matter too. Smaller startups that couldn't secure GPU access often had no choice but to shut down or sell at a loss. During the height of the shortage in 2023, some founders described spending months trying to get hardware only to be outbid by larger competitors. For consumers, the effects were felt as well. Gaming GPUs, which share manufacturing lines with AI chips, saw prices quadruple in some markets. Enthusiasts and independent researchers were simply priced out. China, cut off from the most advanced chips by export controls, has seen its AI development constrained. Though, as we discussed, that's also accelerated efforts toward technological self-sufficiency. And within the tech industry itself, non-AI sectors lost talent and funding. Promising work in fields like renewable energy technology or next-generation materials took a back seat as capital and engineers flowed toward AI. But the broader consequences go beyond individual winners and losers. By 2024, technology and AI investment, which includes infrastructure, was contributing more than 1 percentage point to US GDP growth, according to Bank of America. That's a level of contribution that rivals or exceeds many traditional sectors. According to JP Morgan, AI-related companies accounted for 75% of the S&P 500's gains since late 2022. In other words, a significant portion of the economy is now riding on this wave. If it crashes, the ripple effects could be severe, not just for tech companies, but for pension funds, retirement accounts, and employment across multiple industries. But there's one cost nobody's talking about, and it's not just financial. If this bubble keeps growing, or if it bursts, the environmental fallout could be massive. Here's why. Research estimates that training GPT-3 required approximately 1,300 megawatt-hours, or about 1.3 gigawatt-hours, of electricity for a single training run, producing roughly 500 tons of CO2 emissions. That's equivalent to the emissions of over 100 gasoline-powered cars driving for a year. And that's just one training run of one model. If the current trajectory continues, energy demand from AI could become a significant driver of carbon emissions. If it doesn't, and we're left with massive overcapacity, then we've wasted enormous amounts of energy, steel, concrete, and rare earth materials building infrastructure that sits idle. There's also a social dimension. If this bubble bursts, it could trigger what's known as an AI winter, a period where public and investor sentiment turns sharply negative and funding dries up. We've seen this before. After the dot-com crash, it took nearly a decade for investors to fully regain confidence in internet companies. A similar pullback in AI could delay genuinely useful applications in healthcare, education, and scientific research. But here's the thing, not all of this is bad. Even if the boom overshoots, the infrastructure being built could have lasting value. After the dot-com bubble, the world was left with vast amounts of fiber optic cable. Much of it went unused for years, but eventually it became the backbone for YouTube, Netflix, and the modern streaming economy. The same could happen here. If GPU clusters sit underutilized in the short term, they could be repurposed for scientific research made available to universities at low cost, or used to democratize access to AI in ways we haven't yet imagined. The question is whether we use what's been built wisely, or whether it becomes what economists call stranded assets, expensive infrastructure that no one needs. What's clear is that this isn't just a story about technology or finance. It's about how societies allocate resources, who benefits, who doesn't, and what happens when ambition outpaces reality. And those stakes, personal and global, are what make the next chapter so critical. So we arrive at the central question. Is this a supercycle or a super bubble? There are two ways this could play out. In the first scenario, AI is genuinely transformative. Like the internet or mobile computing, it's a fundamental shift in how we work, communicate, and solve problems. The investments being made today will seem justified in 5 to 10 years, when AI applications generate trillions in economic value. The hardware build-out was necessary, not excessive. This is the supercycle. In the second scenario, this is the dot-com bubble all over again. Too much capital chasing too little real value. Companies overspent on infrastructure they didn't need. Startups with no path to profitability raised billions. And when reality caught up, the correction was painful. Trillions in market value evaporated. That's the super bubble. Right now, the evidence points in both directions. On the optimist side, in 2025, TSMC reported strong year-over-year revenue growth, with HPC and AI representing a substantial portion of wafer revenue and raised its growth forecasts. C-Way stated flatly, AI demand is real and just the beginning. Broadcom and AMD have announced multi-year deals worth billions with OpenAI and major cloud providers. These aren't speculative bets. They're contracted commitments. And historically, transformative technologies always looked like bubbles in their early days. The internet, smartphones, they all face skepticism before proving their worth. But the skeptics have their own data. GPU rental prices have declined significantly as supply improved, with some providers cutting prices by 40 to 50%. Dylan Patel, an analyst at SemiAnalysis, has argued that there's been a huge buildup of inventory under the guise of AI demand. Public estimates suggest OpenAI was spending at least $700,000 per day on compute in 2023, with total costs potentially reaching billions annually. Yet its revenue doesn't justify its valuation, and 95% of companies using generative AI, according to MIT's 2025 study, have seen no measurable increase in profitability. Then there's the historical precedent. In 2000, the telecom industry lost roughly $2 trillion when it became clear that companies had overbuilt fiber optic networks. The dot-com crash wiped out about $5 trillion in market value. By some measures, the AI hardware boom is already comparable in scale. Jeff Bezos called it kind of an industrial bubble. David Solomon, the CEO of Goldman Sachs, warned that much of the capital being deployed won't deliver returns. And then there's Jensen Huang himself. In 2023, he dismissed bubble concerns outright. "I don't believe there's an AI bubble," he said. But by 2024, his tone had shifted slightly. People got overexcited, he admitted, drawing a direct comparison to the dot-com era. The internet was a really big deal, he said. But people got overexcited. So which is it? Is AI, the internet, something real that was temporarily overhyped? Or is it Pets.com, a company that raised hundreds of millions and collapsed within a year? The truth is, no one knows. Not the CEOs, not the investors, not the analysts. The signals are too mixed. Demand is high, but so is supply. Revenue is growing, but profitability remains elusive. Optimism is widespread, but so is caution. What we do know is this: the next 12 to 18 months will be decisive. If AI applications start generating meaningful revenue, if companies can demonstrate return on investment, if the technology delivers on even a fraction of its promise, then the skeptics will have been wrong. The infrastructure being built today will look prescient, but if demand stalls, if enterprise adoption plateaus, if the gap between investment and returns doesn't close, then we'll be looking at one of the largest misallocations of capital in modern history. Right now, we're standing at that crossroads. And the answer, whatever it turns out to be, will shape not just the tech industry, but the global economy for years to come. So where does that leave us? If there's one thing history teaches, it's that major technological shifts are almost always accompanied by financial excess. The question is never whether there will be a bubble. The question is whether the technology beneath it is real. The dot-com crash of 2000 wiped out trillions in market value. Hundreds of companies failed, but the internet didn't disappear. Amazon survived. Google survived. They went on to become some of the most valuable companies on the planet. The infrastructure built during the boom, fiber optic networks, data centers, it became the foundation for everything that followed. YouTube, Netflix, cloud computing, none of it would have been possible without the overinvestment of the late 90s. The companies that failed, Pets.com, Webvan, they were betting on behavior that hadn't yet materialized. They built too much, too fast, with too little proof that people actually wanted what they were selling. The ones that survived had real products, real users, and a path, however unclear at the time, to profitability. AI will likely follow a similar pattern. There will be survivors and there will be casualties. The question is, which companies fall into which category? The next 12 to 18 months are critical. If AI applications, ChatGPT, Microsoft Copilot, enterprise tools, begin generating tens of billions in revenue, if companies can demonstrate measurable return on their infrastructure investments, then the skeptics will have been wrong. The build-out was justified. This is a supercycle. But if demand plateaus, if adoption stalls, if the gap between investment and real-world value doesn't close, then we're looking at a correction, and it could be a severe one. Sam Altman, for all his optimism, has been candid about the risks. People will overinvest and lose money, he said. But he added, we're building something world-changing. Jeff Bezos called it kind of an industrial bubble. Both of them might be right. Here's what we know for certain. Hundreds of billions of dollars, including alliance commitments valued at over $600 billion, have been poured into AI infrastructure in just a few years. Entire supply chains have been reoriented. Governments are treating semiconductors as strategic assets. The decisions being made right now by CEOs, policymakers, and engineers will shape the technological landscape for the next decade. Whether this turns out to be visionary or reckless, we won't know for some time. But one thing is undeniable. We are living through a historic moment. The kind that, years from now, people will look back on and ask, what were they thinking? Maybe they'll conclude it was brilliant. Maybe they'll call it madness. Or maybe, like most things, it will turn out to be a little of both. The trillion-dollar question remains unanswered. Will the AI hardware bubble burst? Or will it change everything? Right now, all we can do is watch and wait and see which version of the future we're building.